Hi, it's Nick Cato with Leo Barrick, and on today's episode of Tax Concepts for Deal Professionals, we're going to be talking about the cash basis method of accounting for taxpayers. Now, this pops up on a lot of tuck-ins or smaller deals where the target company may be on accrual for the book purposes, but is using cash basis accounting for tax purposes. And that can result in some really interesting fact patterns. Like, for example, let's say you bought the stock in a business that was on the cash basis of accounting and you, the buyer, on the accrual basis. One big trap for the unwary that you need to be mindful of is the AR, because the AR is going to have zero basis for tax purposes because they're on the cash basis method. And so you as the buyer need to be able to flag that early on in the transaction, because that's going to impact the way you value that AR. Either, when you look at the AR, you'll say $1 of AR is not worth $1 of cash. And so I'm going to discount the value of that AR by the tax that I, the buyer, will have to pay on the AR when I collect it in the future. Or what's also possible is to make the sellers, file a method change, an accounting method change, which, they would do before the transaction closes or on the final return of the transaction, and, effectively switch to the accrual basis of accounting on their watch, pick up any taxes that would be due on that AR or other assets that would have to be adjusted by going from cash to accrual. And then when you buy that business, you have full basis in the AR, and as a result could pay dollar for dollar for it. That's just a bit of a trap that I see come up on a lot of smaller transactions where the buyer is looking at acquiring a target company that's on the cash basis of accounting for tax purposes. That's it for now. Be sure to check out our other videos on our website or our YouTube channel. We cover a lot of different topics for deal professionals that I think you'll find very interesting.